And that's our chapter 8, which is going to deal with the variable costing now. What's tricky with this variable costing? Now, we're going to have two costing systems again, always two costing, always options for the users. One will be the variable costing, the other one will be absorption costing. Absorb means taking more. What more this absorption costing is going to take? So let's see first what the variable costing is going to take. First, we're going to go back to the product cost. Product cost is direct material, direct labor, manufacturing overhead. We're going to break the manufacturing overhead by two components, variable and fixed. Now, in the variable costing, what we're going to do, we're going to split the cost on the variable and variable only. And we're going to take the variable cost for the product, and everything else we're going to treat as a period cost. So direct material, variable cost, part of our product cost under the variable costing here. Direct labor, variable cost, part of the variable costing for our product cost. Variable manufacturing overhead, variable cost, part of the product under the variable costing. Fixed manufacturing overhead, not variable cost, expense. Now, what's going to happen with the absorption? The only thing that will be different between the variable and costing and absorption costing is going to absorb or going to take into the cost of the product that fixed manufacturing overhead, which otherwise going to be expensed in the variable costing. That's the only difference. Everything else, the period cost, sales administrative expenses, regardless the variable or fixed, they're all period cost. We're going to expense them. So for that reason, which product is going to create more expensive products? Which system is going to create more expensive product? What do you think?
The absorption cost.
Absorption cost. Why? Because he's going to take that fixed manufacturing overhead into the cost of the product, where in the variable cost, that fixed overhead is going to be out of the cost of the product. So that brings us to the question, which method will produce highest value of the work in process and finished goods inventory? And here you're going to say, which one will be?
The absorption as well, right?
Absolutely absorption. Variable will be lower. There's no it depends, only absorption. So let's see example. This company producing a single product with the following information available. They produce 25,000 products annually. Direct labor, direct material, direct labor, variable manufacturing overhead, all the three are $10. Selling administrative expenses, those are $10. Selling administrative expenses, $3. Fixed manufacturing overhead, since it's a fixed cost, is going to be given in total $150,000. Selling administrative expenses is $100,000. Now we have a problem because the variable cost is per unit, fixed cost is in total. Can I convert fixed cost into unit per unit?
Yes.
How much will be the fixed cost per unit? Do I know how many units I produce?
Yeah, it says above. It's $10.
$10. How did you calculate it?
Adding the manufacturing overhead fixed cost plus the selling administrative expenses, and then just dividing it by the number of units produced.
Say that again. Selling administrative expenses, that's period cost, correct? So we don't need selling administrative expenses. We not only, I want to find out how much is my fixed manufacturing overhead cost per unit. That's all I need to find, right?
Yeah, you're
How
right.
right, how can we find that?
Just take away the selling and administrative expenses, right? Just use the manufacturing overhead fixed cost then.
Yes, because remember here, remember this chart. We have to have direct material, direct labor, variable manufacturing overhead. We already know those three are $10. The question is per unit, how much is the fixed manufacturing overhead? Otherwise, I cannot get my cost per unit here under absorption. Make sense? So what will be the fixed manufacturing overhead per unit?
$6.
$6. How did you get it?
Manufacturing overhead divided by number of units.
Thank you. And that's exactly $6. So what will be the cost, product cost, under the absorption costing? Absorption is going to take the $10, same as the variable costing, and going to absorb the fixed manufacturing overhead per unit, which is equal to $6. And we calculate it by the total manufacturing overhead divided by the number of units that we produce during the period. And for that reason, absorption costing is going to give us product which is $16, and variable costing is going to give us cost of the product only $10. Now let's assume now that we have the following additional information. Now the company, what they're doing is they're selling 20,000 units during the year, where there's no units in the beginning inventory. Now we have to compute the net income. Before we compute the net income, let's think about something. They're selling 20,000, correct? Are you guys with me?
Yeah, I'm with you, Ivan.
So they're selling 20,000. How many they produce?
25,000.
25,000. So if it clearly says that they don't have the beginning inventory, but now they're going to have
5,000 units of beginning.
ending inventory,
Well,
right? So those 5,000 units under absorption costing, the cost will be how much? 5,000 times 16, right?
80,000.
80,000. On the variable costing will be 5,000 times $10, and that will be 50,000.
50,000.
So as you can see right here, we're going to have $30,000 difference in the ending inventory between absorption costing and the variable costing. Make sense? $30,000 will be our difference. From where that difference comes from? Because absorption costing holding the $6 times 5,000 units, that's $30,000. Those $30,000 gonna stay in our inventory. Make sense? Under absorption, which we're not gonna have those $30,000 in the variable costing. For that reason, let's see what's gonna happen. In the absorption costing, the sales are sales. There's no magic in the sales. There's nothing tricky in the sales. It's just 20,000 times $30 per unit, $600,000. Now, cost of goods sold, calculating the absorption, we're going to follow the traditional format. We're going to get the beginning inventory, which is 0. Then we're going to add how much we produce, cost of goods manufactured, 25,000 times $16. which is $6 more than the variable costing, $400,000. That's how much we have available for sale. Ending inventory now is 5,000. Why we produce 25? We sell 20, 5,000 ending inventory. $16 is our product cost, $80,000 ending inventory. We already calculated it. So that means that our cost of goods sold will be $320,000. That's going to give us gross margin of $280,000. Variable selling administrative expense, we already know $3 per unit. Since we're selling 20,000 units, that's 60,000. Fixed selling administrative expense, that's $600,000. So the net operating income here under this system for the first year of operation will be $120,000. Now, having in mind that this system holding $30,000 more in the inventory compared to the variable costing, naturally we should expect the net operating income under the variable costing to be different with $30,000. Now, where the $30,000 going to go? They're going to go under period cost. So that means in the variable costing, we expect to see $30,000 less income, which is exactly what's happening. Again, why? Because our ending inventory under the variable costing is exactly $30,000 cheaper than absorption. And the 30,000, they just move to the operating, in this case, under the operating expenses as part of the fixed expenses. So let's see what's happening here. Sales against sales, 600 and one, 600 on the other. Cost of goods manufactured, here they're cheaper with $6 per unit, over 25,000. Units, 250. Available for sale, 200. Now the ending inventory is only 5,000 times $10, 50,000. Then, since we treated the variable fixed, now we're adding the portion of the period cost, which is sales administrative expenses, which also behave as a variable, 20,000 times $3 per unit, 60,000. And we have contribution margin here, $340,000. Then we're adding the entire amount of the two fixed costs, which is fixed manufacturing overhead and selling administrative expenses, fixed cost. That's 250, and now operating income is $90,000. So what's happened? Happened that the $150,000 fixed manufacturing overhead in the variable costing, it's directly period expense. But in the absorption costing, $120,000 went to the cost of goods sold, and the $30,000 sitting in the ending inventory. For that reason, we have that difference in the operating income of 30,000, because the absorption holding the $30,000 into the inventory. Where in the variable costing, we're releasing those 30,000 into the expenses. Another way how we can see it is the variable costing operating income, 90,000. Once we add the deferred inventory or the inventory that we're holding, $6 per unit over 5,000 units, 30,000 is going to give us the operating income under the absorption costing. This is the first year when we're starting with zero balance, producing 25, selling 20. Let's see the second year. This company keep operating. But the second year, what's going to happen in the second year? They're still going to produce 25,000 units, but now they're going to sell 30,000 units. Okay. So now, what that means? We're selling more than we're producing. Do we have those additional 5? Yes, we do. They're sitting in our inventory, correct?
Yes.
Yeah.
So the unit selling price is $30, no questions about it. Variable cost will be again, direct material, direct labor, variable overhead, $10. Selling administrative expenses, $3. Manufacturer overhead, those are fixed costs, they're never gonna change, 150, and selling administrative expenses at $100,000. So let's see how much will be our product cost. Since we're producing exactly the same amount of units, the cost per product is gonna be exactly the same. Why? Because we still have to get the 150 divided by 25. In the first year, we have 150 divided by 25,000. Here, we're going to have 150,000 divided by 25,000. So that's going to generate exactly the same amount of $6, which absorption is going to absorb in the cost of the product, where the variable is going to directly release it into the expenses as a period cost. So the cost per unit is not going to change. Let's see what's going to happen now with the income statement. Under the absorption, now the sales is going to go up because obviously we're selling now 30,000 units, not 20,000. 30,000 units, that's $900,000. Beginning inventory, the 80 now expensive, that expensive inventory that holding $30,000 more, now it's going to be released in the cost of goods sold. So the beginning inventory plus the cost of goods manufactured, everything is going to be sell because our ending inventory is going to be down to 0. So now cost of goods sold here will be higher for us. So now we're going to have extra cost of $30,000 going in our cost of goods sold. The variable will be 90,000 because 30,000 units times $3, 90,000 fixed cost. It's a fixed cost 100,000. So this absorption now is going to generate $230,000. Now, what's going to happen with the variable? On the variable, our beginning inventory will be cheaper, only 50,000. So what that means, that's going to hit us on the operating income. Since we have $30,000 cheap beginning inventory, there will be less expenses in the period. So that means we naturally should expect on the variable costing, our operating income to be with $30,000 more. Let's see if this actually is going to happen. As we just first glance, yes, it is. So sales, 900,000, same. Beginning inventory, only 50,000. Cost of goods manufactured, 250, 25,000 times $10, 250. Cost available for sale, 300. 300, we're selling everything. We're gonna add the variable selling administrative expenses, which is 90,000, which is exactly the same 90,000, which is sitting in the absorption. Then our manufacturing overhead, $150,000, is gonna come as a fixed cost. Same administrative expenses, again, fixed costs coming here. Contribution margin 510 minus those two fixed costs, 250, and we're generating a net operating income of $260,000, which is $30,000 more than absorption. If we have to do reconciliation, will be variable costing, always start with the variable costing, 260. Now we have to deduct the difference that we're holding in the inventory under absorption, which was $6 per unit over 5,000 units. And that inventory now is released in the cost of goods sold. For that reason, absorption is gonna create a lesser income with $30,000. Now, what's going to happen if we check the both periods? Remember, in the first period, we started with 0 inventory, and the second period, we ending with 0 inventory. So what's happening? On the absorption, first period, we have $30,000 more. When we're building inventory, and once we're releasing the inventory, variable create high income. But in total, they're both the same. We cannot change the numbers. How we treat the cost and how we allocating the cost, it doesn't matter. We're always gonna have the same result as long as we start with the 0 balance and end up with 0 balance. Make sense? Remember this. So what will be what we can take from this? What will be the outcome that we're gonna have from this or take out from this situation? First, as long as production is equal to sales and there's no change in our inventory, since what we're producing, that's how much we're selling, the absorption and variable costing will be exactly the same. What that means? So it means if you're running cash business, when you're making, like, let's say hot dogs, and you're making hot dog when the customer come and ask you for hot dog, and your production is exactly equal to your sales because you're producing to order, then there will be no change in the inventory because you're not gonna produce hot dogs and keep it in your fridge. For that reason, if you're running, regardless which system you're gonna run, absorption or the variable costing, you're always gonna have the same result. But if you're producing more than you're selling, then your inventory is gonna increase. As long as you're increasing the inventory, absorption is gonna hold more cost in the inventory. That means absorption on the income under absorption always will be higher because that cost is held in the inventory, where the higher than the variable, because the variable, the same cost which you're holding in inventory and absorption is going to be released in the expenses under the variable. So remember, as long as you're building inventory, increasing the inventory, absorption is going to produce higher income than the variable. The opposite. If you're selling more than producing, then you're decreasing the inventory. As long as you're decreasing the inventory, absorption is going to be always lower than the variable, or variable is going to produce higher income than absorption. So let's see another example. The first part was when we producing the same amount, but we're selling different amounts. Let's see what's going to happen if we're selling now the same amount, but we're producing different amounts. In this example, first we're going to produce 30,000 units. We're going to sell 25. Again, we're going to build at the first year, we're going to build inventory of 5,000. Since we're building inventory, we already know absorption is going to create more income than the variable costing. Let's see if that's actually true. First, we have to come up with the cost per product. We have the direct material, direct labor, manufacturer variable overhead cost, $10. Now we have to come up with the manufacturing overhead cost per product. How can we get that number? And how much will be that number? Can you help me with that calculation? Can you guys hear me?
I can hear you, but I just don't know how to get started.
No, the same way we started on the previous question. So
Okay.
the only thing that I'm asking is how much is the fixed overhead per unit?
Fixed overhead per unit would be,
How much is the total fixed overhead?
the fixed overhead is 30,000?
No, 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 no. Fixed
Right.
overhead cost, dollar amount. Look at the dollar
Oh,
amount.
it's 150,000?
50,000. How many units we produce?
We produce 30,000.
So how much is the fixed overhead per one unit?
5,
Thank you. So you know how to start, you finish it. So you don't know how to start it. That's good,
okay.
right? Okay, so now once we have the fixed overhead per unit, we can calculate the cost under the absorption. Cost versus over the variable costing is easy. We're just getting the direct material, direct labor, variable overhead, $10, and that's our variable costing. The cost under the variable costing. But under absorption, we still want that fixed manufacturing overhead cost per unit to come up with the cost per unit. And as you can see now, compared to the first example, when we're producing 25, since we're producing 30, our unit product cost is a little bit lower with $1 per unit, correct? In the previous case was $6, now it's $5. But since our inventory now is the same, 5,000, we're building 5,000 inventory, times $5 difference between the variable and absorption, that's going to create $25,000 difference between one and the other in favor with the absorption. We already know once we build the over inventory, the difference that we're holding in the inventory is going to show up on the income statement between the absorption and variable costing. So we expect now to see $25,000 more income in the absorption versus the variable costing, correct? Let's see if that's going to happen. Sales, we're selling 25,000, $330 per unit, 750. No beginning inventory. Cost of goods manufactured, 30,000 times $15, 450. We're going to keep 5,000 of the 30 that produce. We're selling 25, 5,000, we're going to keep it. Times $15, that's $75,000. So cost of goods sold is 375, which split the sales in half. Gross margin 375. Variable, we have sales administrative expenses, which is 25 times $3, which is 75. And the fixed cost is fixed cost. On the same administrative expenses, that's $100,000, that's $175,000. Operating income here is $200. Now, since we know the $25,000 are held in the absorption, and we know that the absorption is going to give us high income with that amount, what will be the income that we're expecting to see in the variable? $25,000 less, correct? Let's see if that's going to happen actually. As first glance, it is. We have 175,000 compared to 200, that's exactly $25,000 less. Sales, same amount, 750. Beginning inventory, no beginning inventory. Cost of goods manufactured, 300, $10 only per unit. Ending inventory is still 5,000, but $10 per unit now. So you see, in the previous one, we have 75 sitting in the inventory, where here we have only 50,000 sitting in the inventory. Where the 25 is going to go? Here is going to go with the manufacturing overhead. Where in the other one, only the, how much will be that? 150, 125 is going to go on the part of the cost of goods sold. We're gonna add on the variable selling and administrative expenses part of the variable cost. That will be 25,000 times 3, 75,000. And the contribution margin is gonna be $425,000. Once we deducting the fixed cost 150 and 100,000, we're gonna get our net operating income, which is $175,000 or $25,000 less than the absorption costing. That's the first year. Now let's see what's going to happen second year. Second year, we're going to try to wash out the inventory, bring the inventory down to zero. How we can do that? Well, since we're selling the same amount, 25,000, we have 5,000 in our inventory. We're going to produce less. We're going to produce only 20,000 units. And that's going to help us to get rid of the inventory. Unit sales price, same, $30. Direct material, direct labor, $10. Selling administrative expense per unit, per unit, yes, $3. Now, fixed cost stays the same. Manufacturing overhead fixed cost is 150. Selling administrative expenses, $100,000. Now, how much will be my fixed cost per unit now? Is it going to be $5? What do you think? Help me out here. How did we calculate the fixed cost per unit a few minutes ago?
We just divided
Divided, which one we divided?
by the manufacturing overhead, was it?
Yes, manufacturing overhead divided by which number?
By the number of units produced.
And how much you're getting when you do that?
When we do
7.
this particular equation, we get like
15 divided by 2, right?
15 divided by 2, yeah, which is actually 7.5 or 7.
7.5. 7.5.
Yeah.
We're just going to stay precise, 7.5. So let's see now. In the absorption, we're going to have more expensive product with $7.5. When the variable costing, our cost will be exactly the same, $10, end of the story. Let's see how this is going to affect us on the income statement. Well, it's not going to affect us because whatever we're producing, we're selling it. The $750 here difference between product cost between absorption and variable costing, we're not going to see it because we're selling exactly the same amount. Those units that were coming at the expensive, we're selling them. But the difference is going to come from the inventory that we're holding, the expensive inventory that we're holding in the absorption, which was with $25,000 more than the variable. So now we're going to release that inventory, and that inventory is going to flow in the cost of goods manufactured. 75,000 plus the cost of goods manufactured, 425 gone. Gross margin 325. Variable costing on selling administrative expenses, we're going to have the variable portion 25 times 3 and the fixed portion 100,000, 175. Net operating income here is 150,000. Now, since we move from the high inventory to zero inventory, as you remember, in this chart here, once we selling more than we producing, then the variable costing is going to produce higher income than absorption. How much higher in this case? Well, it should be exactly the amount of the difference in inventory, which is exactly $5. So we expect to see in the absorption income with $25,000 higher than the absorption. Let's see if this is going to happen. Well, it does happen. 750 is the sales, no changes between the both systems. 50,000 the beginning inventory, as you can see it here, the beginning inventory with the $25,000 less. Cost of goods manufactured, 200,000 to 20,000 units times 10. Everything's gone. Then we have the variable selling administrative expenses, which is 75, which is exactly the same under the absorption. That's going to give us $325,000 variable cost. 425,000 is our contribution margin. Now we're going to add the fixed cost, which is the manufacturing overhead cost, 150, and selling administrative expenses cost is $100,000, which is exactly the same under the absorption costing, and we get our income of $175,000. What's the conclusion that we can do now? Conclusion, once we look at the results year 1 and year 2, when we compare them and get the total, under both systems, we're going to generate the same, exactly the same income. Once we start with 0 inventory and end up with 0 inventory. And that income will be $350,000 cumulative over 2 years. But interesting thing is now, the variable producing exactly the same income. With the absorption, there's a fluctuation. Well, one thing that you should know that in accounting, we like steady. We don't like changes. We want to see the same number over and over, period over period over period. That shows that we are steady. That means that the company is working. If we start seeing fluctuation 1 year higher, the next year lower, next year higher again, next year lower, that gives us a nightmare. So conclusion will be the net operating income is not affected by change in production using the variable costing. Net operating income is affected by changes in production using the absorption costing, even though the number of units sold is the same each year. So, explanation of the changes is the variable costing income is only affected by the changes of units of sales. It's not affected by the number of units produced. So the general rule is, once the sales go up, operating income goes down. And once the sales goes down, operating income goes up. Absorption cost. Income is influenced by both changes in units of sales and unit of production. Net operating income can be increased simply by producing more units, even if those units are not sold. That's the tricky part here. So that's one trick for you to show high income in the eyes of the bank. But that will be something for those of you who are going to continue with the accounting. Which are the opponent of the absorption costing? Opponent of the absorption costing argued that the shifting fixed manufacturing costs between the periods can lead to the faulty decision. Now, those opponents argue that the variable costing income are easier to understand because the net operating income can only be affected in the changes of units of sales, not units of production. In fact, when we're producing, this produce net operating income figure which are more consistent with the management expectations. So, treating the fixed overhead as a variable cost can lead to the faulty pricing decisions and can produce the positive net operating income by simply selling less than the break-even. That's because the absorption does not support cost volume profit analysis. And again, treating fixed manufacturing overhead as a variable cost, which is a very wrong thing to do. Unfortunately, for the external reporting, we have to use absorption costing. There's no options here. And since the top executives are usually evaluated based on the external reports, for that reason, absorption costing is the one that more company usually use. Can the company use variable costing? Yes, they can. But it's going to be extra effort for them. Is it going to be practical? Probably. What are the advantages? The advantages are management can find it more useful. We can apply cost, volume, and profit analysis. We can come up with the break-even, see where the break-even is. We can see where the margin of safety is. We can understand what's the contribution margin that generating per selling of a single product. The other advantage is the net operating income is close to the cash flow. It's consistent with the standard costing and flexible budgeting. Easier to estimate the profitability of the product and segment. The profits are not affected by the change in the inventory. That's one thing that you should remember. And you should use it knowing that. You should use it knowing that the absorption, by simply increasing the inventory, you're affecting the net income. You're making it higher. You should know that effect. And if you want to lower the income, just get rid of your inventory. Those are tricks. And the last thing is the impact on the fixed cost on the profit, which is emphasized here. Now, just to summarize, absorption costing. Fixed manufacturing overhead is assigned to the product. Where the variable costing, fixed manufacturing overhead are treated as a period cost. And that will be incurred even if nothing is produced. Which brings us to the idea of just-in-time inventory. And as you remember, as I told you about the company that's selling the hot dogs, which having just-in-time inventory, as long as our production is equal to sales, there will be no change in the inventory, and absorption is going to be equal to the variable. That's what the effect that we're chasing under the just-in-time inventory. We need to match our production to our sales. And in that case, the difference between both systems is going to disappear. And that's your chapter 8.